Genius Maltby channel for precious metals motivation, news, and conversation. Looks like gold's doing a little bit of a recovery from last week's slaughter coming up this morning, but silver really coming back with a vengeance. You could say that's parabolic. It's just straight up there from this morning, and it surpassed the $17 mark once again. So we're above 17, touching on 17.12 early this morning. So silver making what I'd consider a healthy recovery from last week's overselling. We've touched on this before. Let's touch on it once again. U.S. household debt levels rising to all-time highs. These people just can't seem to get a grip or learn a lesson. They're like a bunch of spoiled children. Following the 2008 financial crisis, many observers were surprised by how much many Americans began saving. From 2009 to 2012, total household debt fell considerably, dropping by more than 12% from 08 to 13. According to the Wall Street Journal, that drop was described by Fed researchers as an aberration from what had been a 63-year upward trend, reflecting the depth, duration, and aftermath of the Great Recession. The CMD's latest quarterly report on household debt and credit reveals that total household debt achieved a new peak in the first quarter of 2017, rising by $149 billion to $12.73 trillion, $50 billion above the previous peak reached in the third quarter of 2008. Balances climbed in several areas: mortgages 1.7%, auto loans 0.9%, and student loans 2.6%. We're going to talk about student loans here and look at some charts because we hear a lot about it, and it is a coming crisis. They're going to have to figure something out. Credit card balances fell 1.9% this quarter. Take a look at this chart of total debt balance and its composition. We'll zoom in on it so you can get a better look at the colors and what they represent. We'll start with mortgages. They're in the orange there. You can see they're starting to uptrend a little bit. They peaked there in 08, about quarter three. And then the one I want to really draw our eye to, though, is the red. Look at the red bar that's present in each one of those quarters. That represents student loans. And you can see it is ever increasing. As time goes on, it gets taller and taller and taller, representing an increase in student loan debt. We hear a lot about it because it's becoming problematic, and a lot of them are being unpaid. And well, when debts go unpaid, the lenders have problems, and the people who invest in those lenders or are tied to those institutions will be the ones left footing the bill. I don't know who loans these non-productive, pretentious, entitled little snowflake millennials money to go to school. You know, the majority of them probably don't need to go to college because they're not going to do anything with their college education. They should go out and get involved in an industry or something where they're using their hands, maybe get trained in a trade school or enter some different type of workforce. There's just not a whole lot of occupations that utilize liberal arts degrees and women's studies and all the other, you fill in the blank. I mean, that's a great thing to open up the comment section to, is let's start a list of degrees that are pretty much useless, a lot of those. And a lot of people are going to school at these big colleges, taking out huge student loans and living expenses, and then they don't even work while they're at school. They're just, pretty much partying and doing things and trying to have fun, sleeping in, missing class, and meanwhile racking up tremendous debt. Again, look at the student loan debt compared to other debt models on there. It's the darker blue line, and it's rising fairly quickly. It goes from that 1 there all the way up to the 2.2. These are current debt compared to 2009 peak. And the student debt is rising. So is the auto loan debt. We hear a lot about the auto loan default rate, what's going on there. It is a problem. It's spreading. It's becoming systemic. People are failing to pay their auto loans back, which is going to be problematic for both the auto companies, because a lot of them securitized or whatever, they loan money when you buy a car. You can actually get loans through like Honda or Ford. They have their own security branch, lending branch for auto loans. Now this chart shows the transition into serious delinquency by loan type. And if you look at the student loans, it is rising every quarter. It looks like it's going up. It took a slight dip there in 2016 quarter one, but it is upticking again. Even credit cards, the default on those was very high back in 2009, 2010, and as things improved, the credit card default rate seemed to drop off. But if you look right there, 2017 quarter one, you see a sharp uptick as it's starting to increase somewhat. Mortgage rates down as far as default goes. Auto loans, look at that now. Starting around 2012, 2013, you see it's slowly rising, and we're seeing an increase in the default or serious delinquency of auto loans. And it is popping up in the financial news, and it is problematic, those two. I think student loans and auto loans are going to be the big ones you're going to hear the most about going into the future. And here we can read, moreover, as with home loans in the late stages of the housing bubble, auto loans are seeing a rise in the total number of loans being made to customers with lower credit scores. Thus, it perhaps should not surprise us that serious delinquencies in auto loans are now near a 6-year high. Moving on to some metals news, Commerce Bank to close physical precious metals business. Commerce Bank is to close its physical precious metals business in the next year, a source with direct knowledge of the matter said on Thursday. The businesses that will be discontinued by Germany's second biggest listed bank include physical precious metals trading and related services, the source said. The trading in physical precious metals and related activities comprising refinery services, vaulting, and transportation of precious metals will be terminated within the next year, the source said. Commerce Bank had no comment to make on the matter. No decision has been made over jobs, the source said, with some employees within the business potentially moving internally. The physical precious metals business is largely based in Luxembourg, where a team of 7 is headed by Managing Director for Luxembourg, Adrian Biondi. The bank also has a precious metals trading desk in Singapore. No change is expected to the bank's unallocated products business, the source added. The bank has recently restructured its investment banking operations, which have been folded into its corporate bank. Curious, I'm wondering why they're getting out of it and what's going on with perhaps their vaults and their physical holdings of gold. That's the end of this story. It'll be interesting to see what the fallout is and how much further it goes and what's taking place financially with this institution. Here's a no-brainer. Citi. China's impact on gold market likely to grow. As the largest buyer of physical gold, China's influence on global price discovery seems likely to increase, says Citi. I wonder if they had a team of monkeys working overtime to figure this one out. We covered this in the last year a couple of times, I believe. It's quite obvious that that's the case, especially with the Shanghai Gold Exchange, right? We discussed that at length. Shanghai still holds a prominent position as the largest gold futures market outside of the U.S., despite a reduction in Shanghai Futures Exchange volume for the year to date to around 450 million ounces, Citi says. By comparison, New York-based COMEX gold volume has grown 15% year on year to around 2.1 billion ounces. Hence, while market participants continue to reference the LBMA 3 p.m. close and spot gold prices, both in dollars per ounce, Shanghai prices, renminbi per gram, should eventually play an increasingly important role, Citi says. Analysts later added, we could see London 10 a.m. prices in particular derive more market sentiment from China over the mid-term. And we talked about this when we discussed the breaking news regarding the Shanghai Gold Exchange, the SGE, and what was taking place there. There's a lot of videos. I think we have 3 or 4 of them. If you go back in the archives, you can find them. It's going to have a huge impact on gold trading in the future. And in my opinion, uh, the Asian markets, the East, will be the ones to determine gold price going into the future. They're real into the physical side of things, and the West here really enjoys that this stuff. The paper gold, the paper gold that really doesn't exist, the little fake promises. And I don't think the Asian markets are going to take too well to that. And I think it's going to create an environment in which gold prices have a lot of upward pressure, upward mobility, and they could potentially price the West out of the market. We're seeing gold flow in that direction. We're seeing physical demand increase in that direction over there in the East, and we'll show you a chart here just in a moment where that makes a little bit more sense. So speaking of Western clowns and paper markets, here we've got gold shorts, always naked like the emperor. I actually find myself getting upset sometimes and angry when I read these particular articles. Anything about the ETFs, the paper gold, the shorting, and just all of that environment that takes place, manipulating the prices of precious metals, and these guys trying to make a quick buck with their computer transactions. It's very upsetting, and not because I hold metals and they fluctuate the values of them denominated in dollars. No, it's because they're making easy money off of false promises, lies, and metal that they don't actually own or hold at all. We've talked about how these people take positions in metals, what's required. It's a very low percentage. In order to short metals, these guys only need, like a less than 4% position. I think they can have like $4,200 to control like a $125,000 position in gold or something like that. It's ridiculous. So here we go. The most expensive investment anyone can buy today is paper gold. For $1,260, an investor will get a piece of paper saying he owns 1 ounce of gold, but he is unlikely to ever see that gold. Firstly, most investors who buy paper gold have no understanding of the real reason for holding gold and will therefore never contemplate taking delivery. And even if he did understand the importance of holding real gold, he is quite happy to hold the surrogate alternative, which is paper rather than physical. This is, of course, what the issuer of the paper gold wants. He knows that paper gold buyers have no intention of taking delivery. This is perfect for the seller because he has no intention of making delivery either. And this is how paper markets function. Buyers and sellers are willing to trade pieces of paper that are said to represent an underlying instrument, whether it is a stock, bond, currency, or commodity. This is a very lengthy article, and if you wish to find it and go read the entire thing, I encourage you to do so. But I'm just taking certain pieces of it here that I wanted to discuss and include here. So we're going to skip ahead. But paper markets are illusory. They give the impression that the buyers acquire a real share in the underlying instrument. That would be the case if for each unit of, for example, a currency or gold was backed by real money or real gold. But in today's false markets, that is far from the case. We live in a world of the emperor's new clothes. The people is made to believe that the emperor is dressed in a suit made of gold, whilst in fact he is naked. And that is exactly how the gold market functions today. Shorts are always naked, which means that there is never an underlying asset backing the gold short sale. What the buyer is getting is a piece of paper with zero intrinsic value. This is a perfect situation for central banks, and the major trading houses such as hedge funds. With sufficient capital, they can manipulate any market without ever worrying about delivery. The result is markets which are totally fictitious and bears no resemblance to the instrument that is traded. The gold price is not the price of gold. That is why the price of a paper commodity has nothing to do with the underlying instrument. Paper trading can be leveraged hundreds of times or more, and whatever the price the paper market trades at sets the price for the actual commodity. Thus, the paper market sets the gold price. The gold price is the paper price that the false gold market trades at. That has very little to do with the price of gold, which is what the physical market would trade at if there was not a manipulated paper market. But buyers and sellers are not concerned about the real price of gold because they have no intention of owning the physical since they don't understand its function. But one day, there will be this little boy who will shout out, "The emperor is naked!" And then all hell will break loose. At that particular point, all holders of paper gold will ask for delivery, and just like the emperor, they will find out that there is no gold left in the vaults. The manipulators have then lost control of the market, and the gold and silver price will go, quote, "no offer." This means that gold is not offered for sale at any price because there isn't any to sell. This is absolutely true, especially the part where he's discussing people that really don't have any idea of the role or function of gold. They basically get into it or purchase it uh, because it's kind of a fad, or it's an in thing to do, or they read it in a magazine, to have a position 5 or 10% in their portfolio. They may be seen in commercial on television, or some financial advisor that took a course somewhere advised them to hold some GLD or SLV or some paper ETF gold or something of that nature. They really don't look any further than that. They don't discuss it. They don't think about it. They don't even have a grasp of history or economics. You name certain key dates in history or discuss certain economic principles. I'll give you a perfect example. Perfect example. I was at a gathering of a lot of people this weekend, a sporting event, youth sporting event, a lot of parents and such there. And I had a discussion with a friend who is a physician, graduate from medical school, very educated, very smart individual. Got a tremendous amount of respect for him. I've known him for years. And we were discussing some of these very things just came up. When I'm passionate about stuff, I just tend to talk about it. And I did that thing that I do, the Junius Maltby thing, where I pull out a dollar, a paper dollar, and I pulled out my 1878 Morgan dollar, my silver dollar. And I went down the path of discussing money, what is a dollar, what it represents, what does it mean. And, nothing against this person, more against the educational system, the institutions that we have that are responsible for educating people today. This guy had no clue. He didn't know a single date. He didn't know anything about U.S. currency, about the coinage acts that we ever had. He really didn't even know we ever even had silver as currency. I'm not even kidding you, ladies and gentlemen of the Junius Maltby channel. Breaking news: this guy did not know that at any point in time did U.S. currency or change ever contain any silver at all, or gold for that matter. It was very difficult. I had to explain and break down very simply, in very simple terms, that at one time you could exchange currency bills for money, for gold, for silver. Uh, he was blown away that, before 1965, in 1964 and earlier, quarters and dimes contained silver, and that what that meant. I showed him the Morgan dollar, the date on it. He couldn't believe it. He couldn't believe that I carried it around in my wallet either. So you're looking at, these are people, he's wealthy, he's a doctor, a physician. These people put wealth away and they do invest. Now, an individual like him who's going to invest some of his savings because he's told to, because he makes a comfortable living, he's not going to have any comprehension, any idea whatsoever of the value of precious metals, or why historically and economically and just in the course of human existence the role these metals play and why it's important to hold them. So that's what we're going with here. And that was just one person out of many. And I can tell you that's why that fact remains, that less than 1% of Americans have ever held a gold coin. Less than 1% of Americans hold any precious metals outside of jewelry. And that was a perfect example. You try it sometime. Just go out and discuss these things with people who you think should know, or maybe would have a better idea than the average person. And you're going to find out that nobody really, maybe it's just us, maybe we're just this weird collective group of, autistics that really fixate on this one detail. But that's fine. I think we're going to do very well because of it. And unfortunately, other people are going to suffer basically because of their own ignorance on this subject. All right, moving on. Economic power will follow the flow of gold. The short sellers, mainly bullion banks and futures traders, will fail, since they can't fulfill their contract and the buyers will receive no gold. The market then becomes a physical market, with price being determined by the holders of physical gold. Economic power will then follow the same route as we have seen in physical gold travel in the last 10 to 15 years. The Silk Road countries such as China, India, and Russia will then gradually dominate the financial system with their gold and their currencies. China bought 171 tons in April. Total 727 tons for 2017, on course for 2,000 tons in 2017 alone. You've seen this chart before. Shanghai Gold Exchange gold withdrawals in tons of gold. Look at the pace at which it's increasing there. 2006 through 2017. Look at those monthly gold withdrawals measured in tons. It's significant. This is just to paint that picture again and to reiterate, the gold's flowing east and they're taking physical delivery of it. We'll close out the discussion with the author of that last article, is one of his last statements that he wrote. And he says, there is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as a result of voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. We know that there is a problem in the entire financial system globally. You've seen it reiterated here time and time and time again. Sometimes I feel like there's literally a pile of horse bones on the ground and I'm smashing them with a crowbar, breaking and beating, not a dead horse, but the skeletal remains of a dead horse, because we really have beat these points home for a long time, and I just hope you're not bored of it. I hope you're not bored of the constant precious metals motivation that I feel it's my responsibility to spread to the stacking community, as that's become somewhat of a role here on the channel. Not only, discussing the things we enjoy, different bullion and precious metals, coins, bars, and just having fun overall, but also reiterating and reminding you of the reasons why in the economic environment in which we find ourselves, that we have been thrust into during the timeline of human history. Here we are sitting in this particular time, and what are the decisions you and I have to make to best prepare for what's taking place economically. So if you haven't done so already, and you like this type of thing, if you like this channel and you've been here for all 23 minutes and 22 seconds so far, go ahead and hit that thumbs up button. Share these videos on your social media outlets. Go through the archives, find other videos on this channel and playlists that contain a lot of this valuable information that we've discussed here and passed on, and share it. Also, again, a reminder, if you wish to support the Junius Maltby channel, there is a way to do so. The links are in the bio section of my YouTube, as well as Patreon. The patrons there, which I've been known to now lately include private patron-only material and patron-only content there in Patreon. So there's about 10 of you or so, 10 or 12 patrons there as part of the Patreon, however you want to pronounce it. And I hope you guys enjoy some of the private and custom exchanges that we're having in there. It's definitely something I feel I owe you guys as being patrons of the channel here, and helping support it and keep this content coming, and motivating me and doing the things that you guys do to keep this channel alive and well. So thanks for being part of the Junius Maltby channel. Each and every one of you is one of the many strands that strengthens and keeps this channel alive. Have a great day, have a great week, and keep stacking.